Hey Jess, can you hear me all right? Just waiting for that clock to hit midnight or 1 p.m. Pacific. All right, we are a go, everybody. I would like to welcome you all to our quarterly economic review. And of course, we're just going to kind of go through some things that happened through the months of January through March and see what's going on for everybody here. So I appreciate you joining us. This will be recorded and saved to our website if you have anyone that may want to see it. So again, I beat the drum on this each time we do a meeting, but this is again for our clients and our participants in our 401k plans. You know, we want to have you be armed with knowledge because that's the best way to kind of go through this thing here. So we'll jump on in. Now, last year was a pretty fun year. Market had good returns, and then out the gate in 2025, it seemed like things were going to be business as usual, and then the tariff battle began. So the quarter one didn't end as bad as it could have been. It had a little bit of a recovery, but it really proved to be a volatile time. So that had a lot to do with the fact that we have a new administration in, and they are doing a lot of different things. And so we are just kind of keeping an eye on that thing. So returns quarter to date, everybody knows it's kind of been a little bit rough, but working their way back. Now, what's been with us for the past few years is going to be inflation. So we'll take a look here and see how that's been holding up. You can see it's come way off the highs and still trending in a downward manner. In February, we saw it drop to 2.8 from a 3.1 number. But the Fed's target rate is 2%. So there's still a little bit of ways to go. If for anybody that's been following along, they've really had a difficult time. The president has been aggressive with regards to trying to get the Fed to lower rates, but we look at this and they're not super inclined because the tariffs will have an impact potentially on the upside. So they're kind of a degree in a box because there are reasons to get in the interest rates down, particularly from a commercial real estate perspective. But right now they're standing pretty strong. So still dropping. Now, with that said, so this goes to the interest rates that we're talking about here. The Fed has certainly been vigilant in monitoring the key indicators, labor markets, inflation pressures, all types of things. So we did get a few drops at the end of last year, but there have been no changes year to date here. Now, what's going to happen going forward? Some pundits feel there's 3 more rate cuts in the cards. I'm not sure that's necessarily the case. We do need to see what happens with this ongoing tariff battle, which should linger on for at least a few months. We had the deal with the UK, and then the administration got together in Switzerland with China that was able to put a 90 days pause on things. But there's a lot of things that can happen between now and then. So right now, the Fed really seems to be standing pat. But let's take a look at where yields are and such. So when we compare year over year, we see on the long end an improvement on the 30-year and the 20-year and the 10-year bond. So you can see right now a 30-year bond, at least as of March 31st, is paying 4.59%. Those yields continue to get pressure up. There was a recent bond offering that didn't go quite as well as the government was probably hoping, which is pushing yields up as well. So now people are starting to get paid a little bit for holding longer duration bonds. We're still not heavy in it in our portfolios. There's a lot that can go sideways there if rates were to start dropping, or excuse me, were to continue to go up. That would be an issue, and we'll kind of dig into that. So the new administration, we talked about it a bit already, but there is a lot that they're doing. There's the tariffs. There's this great big tax bill that is on the House of Representatives right now that just got out of the House and going to the Senate. There's the DOGE, there's the immigration, just everything. There has just been a lot of action and activity that we probably have never seen before, at least I haven't seen before, which did create a tremendous amount of volatility in the first quarter. So the big headline that everybody is talking about is going to be tariffs. And it's a prime strategy that the administration has really been talking about all through the election season. And so the premise here is, how do tariffs work? Is we're going to have imports on foreign goods. They basically pay the government a tax, so to speak, and that could be on the percentage of the value or a flat dollar amount. Why are the tariffs used? They're used either to protect domestic industries from a protectionist strategy, to potentially bring jobs here, but also to discourage activity and behavior of countries. We know one of the items that has really been fingernail in the Cobb salad is going to be the fentanyl issue. And so that is a behavioral type issue that they're trying to work through with China and even Canada and Mexico. Also, immigration has been a key point there as well. But primarily, we're seeing that the administration wants to use this to have foreign companies manufacture here in the U.S. to create jobs. And it does also look like the administration wants to keep at least a 10% tariff across the board to help bring in a little bit extra revenue. So there's obviously negotiating with hundreds of countries around the world is going to be a bit of a process. As mentioned, the United Kingdom has come to the table, but only the big dogs are going to be Europe, China, countries like Japan and India, and we'll see how that goes. And so right now, there's some fairly punitive tariffs that are going on out there, and I presume that's obviously to create room to negotiate. Money has been flowing in on that, but what we haven't seen is how is that going to affect the cost of goods? Is our inflation going to go up? We're going to see what happens with Walmart and Amazon and these companies that are selling us a lot of products, us, the consumer, that come from abroad, including China and a lot of smaller countries. And so that's where we go back to where the Fed is. They're sort of boxed in because inflation could start working its way back, even though the current numbers right now are fairly positive. But still, their goal was to get it down to 2%. So we'll see. We'll see. This is still going to be the center of it, and we're looking at this as something that could continue for a few months. So for those of us in the actively managed portfolios, we continue to keep hedges on there. We've removed some of them, but you're going to find gold in the portfolios. This would be our total return type stuff. People that are in income are a little bit different portfolios. We're using other hedges as well, some energy things, and just some items that can yin while the market is yanging, so to speak. And so um, that's kind of what we're looking at as an overall focus. Now, one thing to be cognizant of the fact is the media loves to blow up any situation. So if you do want to drive yourself crazy, then turn on CNBC every day, kind of like I've got in my office here, and you'll get all the headlines you need to pull your hair out because they are going to emphasize things that are headliners, so to speak. And so, ultimately, the people that are hired have hired us to manage their money. You've hired me to get the ulcer, not for you to get the ulcer. And so we are actively on this with the portfolios. We are super happy with the way the accounts have responded this year. And I got to tell you, pretty much every meeting goes with not as bad as I thought. And so, but even still, on the way back up, we're making our money back. But the people that panic, make rash decisions that, and there were folks that we talked to that wanted to go completely out of the market when it was down 20%, as much as 20% in January. And those people just, if they did it, they solidified that pain there. They didn't permit the opportunity to go up. So especially those of you that are in the 401k plans, understand your risks, but know that long term, the market does pretty good. And this next slide will really give you a good example of that. So you can see here, the green line is 40 years, the purple line is 30 years, the blue line is 20 years. You can see the stock market in there has its various ups and downs, but the long-term trajectory is always up. And throughout that, there have been plenty of reasons to exit, including, 9/11, the internet bubble crash, the financial crash, COVID, interest rate hikes in 2022. There's been a lot of dips in here, but ultimately, the market seems to persevere through. And that does include politics as well, because it's a constant. Regardless of what side of the aisle you are on, whoever wins the presidential election, there's going to be people that are unhappy. And those people that are unhappy are scared that the person that won the election will blow it up. And what we find is the market just continues to push through regardless of who gets in. Now there will be things we'll probably talk about next quarter as we get into what's going on with the tax bills and the regulation and things like that, that will come into play. But right now, that's still all speculation. So the key takeaways that I'd like you guys to figure out here is that in the beginning, in the first quarter, we did enter correction territory. So that's just something to be considerate. Tariffs certainly have had a tremendous impact on what's going on with equities and the downfall that we had, and we do think it will bring continued volatility. So just continue to be cautious. The Fed looks like they've essentially just kind of stayed firm on where they are with rate cuts. We just don't see anything coming anytime soon. Probably need to have a little bit more visibility what happens with tariffs. Inflation, again, down slightly in February, coming off of January to 2.8%. For those of you that are looking for less volatility, bonds is still the core of that. We are still pretty heavy in short-term bonds, just a smidge in intermediate-term bonds, and those will be affected more if rates were to go up. But we're just getting paid too handsomely on the short end of the scale right now from an interest rate perspective that it just still makes a lot of sense for us to hold on. If we can see that we're really in a place where interest rates will go down, that'll be a good time potentially to extend duration, go into longer term bonds. But really focus on what you can control, try to minimize the exposure to inflammatory news. Just stay the course. That's what we're here for. Keep an eye on things. But if you ever do find yourself in a situation where you have questions and you want to know what's going on, our lines are always open. You can call us, you can email us. Again, for the participants in the 401ks, if you're not totally keen on what's going on, we have a handful of advisors here that can help you out and keep you on track and even help educate. So, discipline is the key to winning with the stock market. If you've got a long-term plan, stick with it. Contact us if you got issues. And again, we're always here to address your concerns. So I always like to joke about this. My favorite part is compliance. Um, Please screenshot this and read it and memorize it. It's the most important part of the presentation. Just got to make sure we're on the up and up. So I'll leave this up here for a smidge. So I don't get in trouble. Don't want the hand slapped. Okay, I think you guys should all have that. And so if anybody has any questions, now is the time. There should be a chat feature or a question feature up top where you can put something in and ask it. You're thinking it, ask it. Ask me the pointed ones, the stuff that will get things going. We love questions here. Give me some stuff to talk about off the cuff. Love it. But ultimately, again, we appreciate you guys. And, you know, again, this presentation will be on the web probably early next week. So you're welcome to share that with friends. If anybody's interested in our newsletter, we're happy to get that out as well. But I will be here and see if anybody has any questions. All right. Well, if you change your mind, you have a question, drop me an email or give us a call. And if there's anything specific on here, then we can tackle that. But right now, the portfolio is holding up really well. We are cognizant of the fact of what's going on. We're going to keep a degree of our hedge in there. But for the most part, our equity sleeve is designed to be in the market, and that's kind of what we're doing right now. So it's great chatting with y'all. And if you have any questions, hit me up. Have a good rest of the day.